All right. Hey, everyone. This is a long-promised debate between Haseeb and Gwart about whether VC-funded tokens in 2025 are vaporware or vapor or sublimate, depending on your view of what vapor is. You know what sublimation is, Haseeb?
I know what sublimation is.
Okay, just check. I think the idea here is that Gwart and Haseeb got into a little bit of a tiff on Twitter, and I will read out those tweets, but actually I will just share my screen so you can at least kind of get an idea for what this
All right, we can also link it in the show notes, by the way.
All right, cool. Yeah, I will read it at least so that everyone gets.
So give me a dramatic reading, though.
Gwart's side
give
is
each of us voices.
I don't see how VCs don't get annihilated this cycle, or whatever you want to call it. No one is buying these tokens. The mask is off. I really don't even see any outlier 100x's that can carry these funds. Just zeros across the board. There is just no natural buyer for this vapor. Gwart, how do you think I did on the interpretive dance of reading your tweet?
I thought the intonation in your voice were a little annoying, but that's okay.
I've been a VC in crypto for almost 8 years, and I can't tell you how many times I've heard this crap. Fundraising for crypto VC in 2018, 2019 was brutal. No one is buying these tokens. The mask is off. I don't see any more returns in this bullshit industry, etc. Put your money where your mouth is and short the market if you think that. See you in 3 years and we'll compare notes. And so that's Haseeb's side. I don't know if I got the air of
that's exactly what I sound like.
VC,
I think you nailed the august tone with which I carried myself. Thank you.
All right. So I'm going to start with sort of a softball question, but I would say the sort of like binary left versus right philosophical divide in crypto to many people in the spaces. You either believe in one token, i.e. there's a Bitcoin and nothing else, or you believe in arbitrarily many tokens, which is like people should just keep making more and more tokens. Of course, the natural problem is in the latter case, the marginal value of the 10,069th token is basically going to zero. So it might actually go to zero so fast that it doesn't support any real economic value beyond market manipulation. Do you agree with the sentiment? Do you think that, hey, this idea of infinite tokens is fake? Maybe it's like, hey, there's actually really like a carrying capacity. Or do you think like, yeah, actually there really are only two options. You either have one or you have a million and there's nothing in the middle. Let's let Haseeb go first.
All right.
Sure. So there's basically always been infinite tokens. And by infinite tokens, what I mean is tokens beyond the carrying capacity of the market, right? Nobody can seriously underwrite thousands of tokens. But if you go back to 2017, there were already thousands of tokens. You go to CoinMarketCap and you start just clicking next page, next page, next page. There's just too many for anybody to be able to meaningfully understand what are all these tokens doing. And of course, most of them are doing nothing interesting. That's always been true. In the same way, the internet has always been full to the point where you will never get to the end of the internet. So that property of crypto and crypto markets has been true for almost a decade now. It's basically only, maybe 2015 that you could meaningfully have underwritten everything in the market when they were just Bitcoin forks and, Litecoin and Mastercoin and stuff like that. But we've long left that port. So I think people claiming that, well, what's happened now is this hyper acceleration, that there's now just too many tokens and that's what's collapsed the market, is this massive oversupply, that ignores the fact that that's always been true. That's always been a property of the market, that there are way too many assets. It's almost like saying, this is the reason why the stock market's going to collapse, is because there's too many stocks, there's too many companies, nobody can underwrite all of them. And of course that's true, which is why the overwhelming majority of the liquidity in the market is in the S&P 500, and even those in the S&P 100. But this doesn't mean that there's no economic value outside of the S&P 500. Of course there is, but it's not well understood. It's not deeply underwritten. There's not a lot of liquidity around it, and these things are less valuable. So what you should expect to see in a mature market is a power law distribution. right? Something that follows something like Zipf's law, which is that the biggest thing is like twice as big as the second largest thing, which is the third largest thing is like a third of that, fourth largest thing is a fourth of that. That's the same distribution that shows how big countries are. Same distribution that dictates how big cities are in population. Is a very, very widely sort of universal law for things that have network effects and that tend to get bigger with scale. And it's also what you see in crypto market caps. Is if you just go look down the list, the biggest thing, like they roughly follow a power law distribution. And that's basically always been true. I can't remember a time when crypto market caps didn't look like that. So I think my base case for this is that more or less things are kind of the same. I don't think things have changed that much. Obviously, macro has shifted a lot, and that's resulting in a lot of this flight to safety that you're seeing over the last 3 months in particular, where alts have weakened really dramatically relative to Bitcoin. But I don't think you should infer too strongly from that something fundamentally has changed about markets. That sounds implausible to me, given that the real obvious thing that's changed everywhere is that, macro's in a tailspin and, there's like a global recession coming our way.
All right, Gwart, what's your either respond to Haseeb and say like you don't agree with something, or where do you feel on the spectrum of like one tokens, infinite tokens, or they're somewhere in the middle?
Yeah. Okay. So first of all, I would just note that my sort of incendiary post on Twitter, I mean, obviously I have, some engagement, rage bait tactics. And so you need to assume that, not everything that I believe is necessarily articulated in that single post. The first 90% of what Haseeb said, I, directionally agree with. I think that when I say the mask is off, okay, my view on the market going forward is that the vast majority of tokens in the past 5 years, you could extend that a bit further, to ICOs as well, has been infrastructure. And we have these massive infrastructure rounds. And I don't want to be, too particular right now on how I define infrastructure versus applications, because I think that in and of itself is sort of becoming increasingly difficult. But I would just say that there have been these massive valuations for infrastructure tokens. And so to go back to your original question as to whether there's a single token that, captures all of the value versus, a plethora of tokens, I don't think Haseeb's wrong in saying that there's going to be a power law distribution. My main claim is that these infrastructure tokens that have existed now for 5+ years and that are still being funded are grossly overvalued. And I think we get very fixated on high FTV.
New infrastructure tokens or existing ones?
I would say both for the most part. And I think part of the disagreement here, and I hope to facilitate a good debate, but I'm hoping we at least disagree, because at least, like I said, 90% of what you said, I generally disagree with. I agree with. The point about infrastructure tokens to me is that I do genuinely feel, and this goes to like whether, Bitcoin versus, myriad tokens, I do genuinely feel that most of these are structurally incapable of capturing much value in the long run. I think that what we have generally funded are open source, public goods. I mean, this has been sort of a bastardized term, but these open source protocols that simply in the long run will not capture much of the value to the token itself. And so now, when I say the mask is off, there's a few things that I mean there. First of all, I've seen all of these. I say all of these. I mean, Haseeb may have some counterpoints, Solana being one, obviously. But I see the vast majority of these trending down in USD terms from where they launched. Also in Bitcoin terms, but I did concede beforehand that like some of my comments about Bitcoin underperformance may not be like so relevant to VC investing particularly. And I think that that's a fair counterpoint. Like, I don't think we need to get like, ETH BTC or whatever it necessarily involved here. But so that's the first point I would make, is that like I have just observed this in practice, and this has been, I think that is generally true. And then I like on a longer time frame, I'm being a little bit wordy here, but on a longer time frame, I do think that these things are just fundamentally overvalued. And so we can get into that. But to answer, like to be very concise now at the end, I'm not saying that there's only going to be Bitcoin, right? Like I do consider myself first and foremost a Bitcoiner, and I do think that in the long run, it probably captures the vast majority of value. And I do think that Bitcoin dominance could go to 90% in the long run, just because I don't really see a lot of these tokens capturing the value. But it's not to say that there's not going to be, a ton of other tokens. And it's not to say that those other tokens can't have value. I just see them trending more to their utility value effectively, if you want to be like more specific.
Okay.
Okay, so hold on, let me respond to that. So first and foremost, let's kind of establish what your worldview is that I'm arguing against. Do you think Solana is overvalued?
Yes.
You do. Okay.
Yes.
What do you think Solana should be worth?
I mean, I think that there's just I think it's very difficult to project Solana at like what Kyle Samani would say like $1 trillion asset. Like to me,
well, it's not valued at $1 trillion.
No,
so
no.
Don't worry about that. That's not. You're
Okay.
not arguing against Kyle Samani. You're arguing against me.
Yeah. Okay. So I mean, I don't think that there is very good reason to hold a lot of smart contract tokens beyond just needing to use them sort of as working capital. And as a result, in the long run, I think that what we see is like extremely high velocity of these tokens. And that can mean the market cap can be much lower to support the economy of these smart contract platforms. So I don't know. I'm not going to give like valuation for Solana, but like right now it seems.
But the valuation methodology that you endorse is the only use for these tokens is consumptive use.
I mean, I think there's going to be people who stake these tokens, right? But it's not going to be necessarily for investment reasons. I think they're going to have reasons beyond, wanting to hold these tokens. And what I mean by that is like, MEV or being able to order transactions. Like we're going to see people holding stake because of some external reason that they can make money doing so, or they're a staking service, right? So
Sure.
Recently there's been this discussion of REV, right? And I think that just like fees, REV will also trend to zero in the long run. And so then how do we value these assets? Or we value them off cash flows? Cash flows right now, were you about to say something, Tarun? Go ahead.
I actually think this is a good point, which is actually a slightly different thing, which is, can each of you spend, 30 seconds to 1 minute describing what you think a valuation for a token should be? Like what components are that go into the valuation, how you rank them and how you weight them? Because like clearly one difference that's standing out here is that, you are going to this kind of like utility cash flow value immediately versus, for everything other than Bitcoin. And I kind of think having a clear stance on like for a given token, whether it's Bitcoin or not Bitcoin, or, it's the 100th token or the second largest token, what components of value do you ascribe to them? And how do you rate them and how do you rank them? Because I want you to answer this question first for crypto tokens. And then next, we'll also compare your answer for private tech company, like AI stuff. Because I think we need to juxtapose so that we actually see like how you think about values of these things. So let's start with that, because I think maybe we can work backwards from that.
Haseeb, go ahead.
Okay. So,
and also just, one point, I think, just like, so we're on the same page. We're talking about right now, general purpose L1 platforms for the sake of this conversation.
We can skip Bitcoin if you want, because like I guess people obviously.
Well, I think it's worth again finding a little bit of common ground. Is that I agree with you that I think Bitcoin is going to become really, really valuable, and it would not surprise me if Bitcoin dominance increases over time. But that's largely because Bitcoin's TAM is just so big. Right, Bitcoin's TAM is in the tens of, potentially like 10 trillion. That is so big that it may well dwarf everything else. Even if ETH goes to 10K, or even if Solana goes to 500 or whatever, that's still going to be dwarfed by how big the shoes that Bitcoin can fill. So it's sort of like, okay, all of tech might really get big, and like internet companies might become really valuable, but Google will just become so much bigger than the rest because of how important search ends up becoming, or something like this, right? This story is not incompatible with my worldview. I'm not in principle committed to Bitcoin dominance going down or Bitcoin dominance being mean reverting. I don't think that's necessarily true.
Yeah, that's fine.
Even in a world where VC investment in crypto ends up still being quite profitable. So okay. So to answer the question about valuation, I think it's pretty clear that right now there is no market agreed upon way to value L1s. Right now, it's L1 valuation is a confluence of things. I'd say the three general components are: one, consumptive use / utility, which is the floor that you described, which is okay, this thing is pure commodity. The second is equity. It's equity in this network. This network generates fees. There's some kind of implied cash flow. Obviously, it's not literally cash that you're generating, because you're generating in kind. So you get more SOL if you're a Solana staker. And then lastly is the monetary use. And this tends to come and go. there's a very, very small economy for most of these things, but it's not zero. And it's possible in principle that some of these things can have a real economy, the way that Bitcoin has some degree of monetary use. And I think it's possible that, you see it a little bit with meme coins, you see it a little bit with NFTs back in the day, that, okay, there is an economy that is priced in this asset. It's not big and it's not the lion's share of the explanation, but there's nothing to say that, 5 to 10 years, that kind of phenomenon seems to keep coming back. And when it comes back, it sort of takes a bigger form each cycle. And so that's something that, again, markets are giving some weight to. So I think it's a confluence of those three, and there's no clean formula. Anybody who claims that there's a clean formula of how they're valuing L1s is either lying to you or they're lying to themselves.
Yeah. Okay. So, I mean, again, agree with most of that. I think the strongest...
Sounds like I'm winning this debate.
Well, I mean, I don't know that we've disagreed much yet, but
okay.
So here's my here's something I would say. I heard this recently, and I don't think it's likely to happen, if this makes sense, but it's a model. And the model is that every L1 is market cap valued on its probability of becoming money. Now, to me, I think that the likelihood of these becoming money is extremely low. And I do think there is very, very strong reasons to think that we will aggregate and consolidate around a single monetary good. Okay. This has been the case in the traditional world. People will point to like the biometallic standard. I don't think this applies in crypto. I think that like we need to separate the utility of silver and gold versus Bitcoin and Ethereum. Like I don't think it's a transferable analogy. I think that what we are working with generally with L1 smart contract platforms is these tokens are this sounds quite reductive, and I tweeted this one time about Celestia, but like these are effectively decentralized AWS credits. Like this is how I would value L1s. And I would look at them as a function of what is the monetary base. I mean, going like truly back to like some of the original discussions that people had in 2017, what is the monetary base necessary to support the economy of one of these L1s? I do not believe there is going to be an extremely low velocity and a reason to hold assets beyond their utility use. So I don't know. I don't know how to rank this, because my base case long run is that these, and to add one extra point, there was a lot of talk in the past about forking. And I think we've realized that forking has taken on a bit of a different, like a different form, in the sense that there are network effects for Ethereum. And so this idea of just being able to instantly fork such that, if anybody's like seeking economic rent on one chain, you can just instantly fork. That hasn't really been true. But what we have seen is Ethereum started charging $100 fees on Uniswap, and Solana comes about, right? It's taken on a bit of, it's not a direct fork. But what I will say is that in the long run, each additional L1, assuming it is being used strictly for the purpose of, whatever people do on this L1, we're going to see continuous L1s crop up, likely with lower valuations, but they can serve the same purpose as one, primary smart contract platform. You could even argue that L2s are forks of Ethereum in and of themselves. So what I see, again, in just to summarize, like what I see in the long run is that, one, not like monetary good that has a very low velocity and is considered a store of value. The rest ultimately trending closer to their utility value. And I will tell you that all smart contract platforms right now are valued on many, many multiples. In fact, orders of magnitude higher than what I would consider to be their utility value.
So, okay, that's definitely true. But I think the analogy you made between, okay, all these smart contract assets, the native assets of these smart contract platforms are basically like AWS credits. That would only be true if AWS or if Amazon did not have stock and instead were buying back AWS credits proportional to the amount of cash flows it was generating, right? Then it would actually be, that would be what a tokenized AWS would look like. Can you agree with me on that? So it's clearly different in kind from what AWS credits actually are. AWS credits are a liability of, like a cash denominated liability of Amazon, but there's a separate asset that's Amazon stock, right? And Amazon is buying back / distributing dividends to Amazon stockholders, not to AWS token credit holders.
Yeah, that's fine. I mean, I don't...
If the two of them were the same asset, it would be a really different thing. And that's kind of what L1 native tokens are.
Yeah. Okay. But I don't know what I'm a little bit confused on like what that has to do with the valuation aspect.
Because you're claiming that, okay, there's this tripartite component of any L1 that you agreed with me on. That's like money, commodity, equity. And you're claiming, well, and it's really only the commodity. The only thing that this thing is going to be used for, or the only reason why you should value it is purely the utility usage, like an AWS credit. And I'm claiming that, like, well, that clearly can't be true because this is not like an AWS credit. This is like AWS credit combined with AWS stock in the same asset. AWS is buying back AWS credits using their revenue, right? This is what blockchain L1 tokens are actually like, which means that you should not just be valuing them on the utility value.
The Gwart Show is sponsored by Ellipsis Labs, who I've been following for 3 years now. They're one of the strongest teams I know in crypto. Ellipsis Labs is a small engineering team with a flat structure. They build complex systems, primarily in Rust. For engineers who like challenges, here's the kind of problem they solve. A layer 2 blockchain needs to maintain 100 million accounts and generate a state root after each transaction batch. The root must be built within 50 milliseconds. How would you design a system to ensure the root construction is fast enough? High-performance challenges are core to Ellipsis Labs' mission as they build modern crypto finance. They believe finance needs more than an upgrade. It needs a complete rewrite. The success of their first product, Phoenix V1, speaks for itself, doing over $70 billion in organic trading volume. Now, Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. I know this team personally, and I like them because they're unique in the crypto space. They have a long-term focus, they work in person from their New York City headquarters, and they're here to build products that fundamentally change the world of finance. If you want to learn more about their open roles, go to ellipsislabs.xyz/careers. The long run of proof-of-stake systems is that it constantly adjusts. Now, this is why I think, side note, this is why I think the REV discussion adds a component that makes this very difficult in the interim, right? As MEV is extracted, as we see like very high priority fees when these could be easily pushed off to a single sequencer L2. REV makes this discussion difficult, but in the long run, I don't know if you remember, but like during
the discussion is difficult.
Yeah, no. But let me explain. Do you remember during the merge, like right before the merge, when like Justin Drake was discussing like how proof of stake was designed, and he said like this is like a virtual ASIC, right? And what do we know about ASICs? What do we know about like Bitcoin? And
also, though, I'm not exactly sure Justin is known as the greatest marketer of any concept in Ethereum.
Well, I'm not. I think a lot of people would agree with you, but my point here is that a virtual, like, what do we know about Bitcoin mining? Well, like it constantly adjusts to its commodity value. The difficulty adjustment is such that every 2 weeks, it should roughly be like the cost to mine a Bitcoin should be roughly proportional to the price of a Bitcoin. Okay, the same logic applies within proof of stake, right? Like it's a virtual ASIC, and this is why, like, I mean, at the time when we were like looking at the merge and like they were talking about the deflationary mechanism, like, look, there is no long run equilibrium where ETH is deflationary. It literally cannot happen. When people are extracting economic rent, which is what happens essentially when you're burning coins, more stake will be added to the network and the yield compresses back to zero where there is an equilibrium where there's no deflation nor inflation. That is the optimal, okay? But what we see now...
Hold on. Okay, let me push back on that immediately. So first of all, the total amount of inflation for Ethereum, if more people stake, goes down. That's actually disinflationary because Ethereum cuts the issuance as more people start staking because of the fact that it's like, hey, we're now overpaying for security. Ethereum
and then it converges
in terms of security budget.
And then it converges such that if it becomes deflationary, there is money to be made. It's real returns as opposed to like net zero. It becomes real returns. And then people add stake to the network again, such that it becomes an equilibrium in theory at zero inflation.
So that's only true if the opportunity cost of Ether in DeFi is higher than the opportunity cost, is higher than the opportunity cost in staking, right? That will compel more capital to move. But if the opportunity cost in DeFi is higher and you can get a better yield not staking, you don't care how much REV or how much burn or how much deflation is happening. It's irrelevant to you. If you own ETH, all you care about is what's the opportunity cost. And if the opportunity cost is better somewhere else, you will not move your money into staking, right? Think about it this way. Ethereum decides I'm going to spend, let's say, $1 billion a year on a security budget. I just made up a number. I don't know if that's a number. Whatever. Let's imagine that's the number. Okay. The security budget is going to be $1 billion a year. That's how much total inflation we're going to spend to secure the network. All right. If REV goes to 1.5 billion or 2 billion, Ethereum is not going to be like, well, great. Now let's raise the security budget to match it. Right. You can imagine in principle, this is how it works. I don't know if this is exactly how it works, but just grant me for the moment, this is how it works. In this model, there is no magical countervailing force that will make the asset inflationary. It just won't happen. Like if you're spitting out $1 billion of tokens a year and there's $2 billion of burn, the thing will deflate.
Yeah, and what I'm saying is that's never happening. Like, do you think there's ever a long run where ETH is?
It did happen at the beginning of the burn.
If I'm getting this correctly, Gwart, you're just saying because rollups basically ensure that there's no real rev that like this happens. Okay. I think you had to add the fact that rollups cause the decay.
And then Solana, and then Monad, and then Barachain. I mean, I'm getting outside of the realm of the interior.
You're getting into this. You're basically saying the following, if I'm going to distill this correctly. There's a fixed amount of roughly total rev across every chain. And each new incremental chain actually like decreases the amount of revenue per chain. And so then eventually you hit this equilibrium where like no one can be deflationary. That's if I'm kind of trying to distill what you're saying.
Well, it's clearly, again, that like, it's clearly true that yes, new chains, new startups siphon demand from the incumbents. I agree. Yes, clearly that can't.
But in crypto, I guess they do it much faster than in traditional tech. That's not
much faster. I disagree with that.
My point my point about why I don't think it can be either perpetually deflationary or even it will have a very difficult time being net zero is because my base assumption going back to when it moved to proof of stake is that Ethereum had what was essentially monopoly pricing power. And when people were paying $100 to swap on Ethereum, you could make some crazy arguments about the long run, burn, REV, whatever you want to say. But as we incrementally add L2s, additional chains, you will convert again. And this goes like to the Bitcoiner point, because people are using Ethereum for its utility value as opposed to a low velocity asset like Bitcoin that they hold. In the long run, there's no deflation because people are constantly finding cheaper ways to do things. And it doesn't cost...
Hold on. Pause again. Bitcoin is not deflationary.
No, I'm not saying...
Bitcoin is inflationary.
No, I'm not saying Bitcoin's deflationary.
Okay, well, you said it cannot be like Bitcoin deflationary. Well, okay, Bitcoin's not deflationary. Second, Ethereum right now, at the current rate of burn, has less inflation than Bitcoin does.
Yeah, because they changed it. You can just tinker with the little mechanisms. Like in 4 years, it'll be either the same or
they didn't change anything. I mean, they changed things at the merge, which was the thing we were talking about like years ago. Yeah. This was like 3 years ago. This was not in anticipation of the L2s are going to siphon demand, so we're going to tinker with the monetary policy in order to make us less inflationary than Bitcoin. Ethereum is right now at steady state, even with the small amount of economic on-chain activity relative to where they were 2 years ago. It's still less inflationary than Bitcoin. Now, of course, Bitcoin, that will trend down over time. Ethereum may also trend down over time. Who knows? We don't know where things are, right? But the idea that, the problem is that this thing is more intrinsically more inflationary than Bitcoin, I don't think that is the explanatory story. Hold on, one more point I want to add. I think you're also making the wrong measurement of what derives value to the asset itself, okay? So you're pointing out that net Ethereum inflation is above zero. For a short time after the merge, it was below zero. So it was actually deflationary. Right now, it's inflationary, very mildly. That is not the relevant question, actually. The relevant question is, if you're an Ethereum staker, what is the real inflation rate for you? Right? Because if you own ETH, you have the right to stake it. You don't have to stake it. You can choose. It's sort of like, buying a stock and not getting the dividend. So the question is, relative to your staking income, how much is this thing deflating or inflating? For Solana, if you stake Solana, I believe right now, I could be wrong, but I believe if you stake Solana right now, Solana is inflating relative to the staking rate, right? You're still getting inflated away, even if you're staking Sol. Because of just the enormous amount of Sol supply that's being minted in emissions. Okay. For Ethereum, if you're staking Ethereum right now, you're actually deflating. So what's happening is that there's a net transfer that's happening from non-stakers to stakers, right? Stakers are owning more and more a percentage of the network over time. And that net transfer is the actual economic value. It's kind of like for Athena, the people who own, the people who are not sort of getting the yield, they're economically irrelevant to the value of the asset, because the value of the asset is only meaningful for the people who are trying to actually get the revenue from the asset. So the value for Ether to stakers, meaning like the total amount of implied inflation/deflation they're getting, that's the quote unquote real economic value of the asset.
Okay, that's fine. I think that maybe a more broad point that we could work off of that I would make is that staking is not a reason to hold an asset, first and foremost. Okay, first you need to want to hold an asset, and then the ability to stake it is you make that opportunity cost within, actual staking or DeFi. But
totally disagree. If an asset if you think the non-staked version of an asset will lose value over time, but the staked version of the asset will gain value over time.
No, but
because the boundary is.
But why do you think it's going to gain value over time? But why do you think it's going to gain value over time? That's my point, right? Like people hold value over time without the ability to stake.
Yes, correct. Because that's not part of that economic equation, right? But if there were a yield generating version of Bitcoin and a non-yield generating version of Bitcoin, and the non-yield generation of yield generating version of Bitcoin would not make money, but the yield generating version of Bitcoin would make money, there's nothing logically incoherent about that at all, right? Clearly, that's a quite sensible model of how an asset might work. Is that the version that makes 8% a year more is going to make money, and the version that makes 8% a year less is not going to make money.
Okay.
If you had a stock that had 8% less returns and dividends, you'd be like, okay, well, yeah, maybe that stock is actually worth negative value. Not negative value, but it's going to go down over time.
Okay, but what I'm saying is that staking is not alone a reason to hold an asset. In DeFi summer, you could get 10,000% APY, and it still was not.
Yeah, the APY alone is obviously not the reason. Yes.
Okay, so that's the point I'm making, just like strictly in terms of like staking alone is not a reason to hold an asset. And so I do not believe in the long run that staking will be enough to justify holding ETH. And over the past, since the merge, we've seen it trend down versus both Bitcoin and dollars, right? And so it was not a good reason to hold ETH.
Of course. But let's say you think that the median expectation for this asset is that it will go down 3% in the next year. Okay. That's sad. That's unfortunate that this asset's going to go down 3% every year. But the yield on staking it is 10%. Okay. That means that you don't want to hold the asset. But if you can get the stake version, actually you're willing to hold the asset because now you have a net return of 7%. Right. This is not hard math. This is a very reasonable universe in which it's not that you make the decision first to hold the asset. It's that the stake version of the asset and the non-stake version of the asset are actually very economically different.
Okay, Ethereum has ETH has gone down much more.
I agree with you. The margins are exactly.
So ETH has gone down much. Right? No. But since the merge, ETH has gone down much more than any staking rewards that you got, unless you looped it 18 times through eigenlayer and stuff. Okay, so then I don't know where we're in disagreement here.
Yeah. No. We're in disagreement talking about the economic model by which to understand these things. That's what we're debating. We're not debating. I'm not defending Ether. I'm not telling you Ether was a good investment. Obviously not. But what we are arguing about is what makes L1s valuable. And is it true that because an L1 is inflating in net terms, the value of the thing is negative?
I think you guys are getting pigeonholed a little too much on just focusing on ETH, whereas like this whole debate is actually about the marginal new chain, whether it's a marginal new L2 and marginal new L1. So there's sort of this.
It matters because if ETH doesn't have any value, then nothing else can.
I don't know if that's true anymore. I don't think that's true anymore. I don't think that's true anymore.
Why would that not be true for Solana, for Avalanche, for all these other chains?
They can still be valuable, just not as valuable as they are. Yeah, they can still be valuable, just not as valuable as they are.
Okay, but you're basically arguing that all L1s, we're not talking about Monad is overvalued. So you're arguing that even Ethereum, Solana, all of that shit's overvalued.
I have a different argument for you,
fine.
which is if I take the roll-up ecosystem, right? Like, so I think inherently, everyone, even the most Ethereum bull people at this point have to agree that L2s are just fundamentally a parasitic to Ethereum's economics until they hit some scale, right? Like until they generate enough in blob fees, which they'll never do, right? So I guess my point is, if I look at Ethereum, they basically went the affiliate route, right? They're like, we have all this revenue, we're gonna pull an Amazon and like let all these affiliates sell via our distribution, but actually we're gonna charge them zero to do that, effectively zero, basically nothing, right? And what happens is you have this really bad problem where the nth L2 that joins actually increases the hurdle rate for you to be economical, right? Because like each new L2 is like extracting a little bit of demand from the L1. And at some point, it just like extracts so much that like you can't grow. So my point is more that I think the roll-up roadmap gives you extremely different economic behavior on the incremental new competing chain versus Solana.
Okay,
right? Where like,
wait, let me just say something. I think the real black pill, if you want like my deep down, right? You want the black pill.
Okay, we finally got there.
The black pill is that Ethereum is doing nothing wrong. And what they attempted to do was export ETH the money. They gave up all this execution, right? They gave up all the MEV and they said, we're going to export ETH the money, because their assumption after DeFi summer was, wow, people are holding this asset. People are viewing this as money. They're buying NFTs in this. They're swapping on Uniswap in this. People are viewing this currently as money. So let's export money to these L2s, right? Well, it turns out that obviously this decimates the execution layer fees, right? Because they pushed all that off. But what I'm saying with the black pill is that perhaps ETH is doing nothing wrong, and all this underperformance is truly a function of the market realizing that things are easy to launch now. You can always launch your own chain. You can fork a GitHub, and at the equilibrium, this asset will converge on its utility value. And they thought that there would be a monetary premium on this. This is why they pushed this. So I think that's the real black pill. Is like both. Like I think, here's one last point I would make. When Ethereum people, this is a very good point that Ethereum people make. They say, are apps on Solana parasitic to Solana? And from my perspective, it really truly is the exact same thing, in the sense that on Ethereum, we have these L2s being parasitic to the execution layer. On Solana, maybe this isn't necessarily the case yet, but if they start capturing way more of the fees, then it's equally as parasitic. Now, I tend to agree with Tolly and Max Resnick that execution is where the value is at, but in the long run, I think this trends to zero anyways. So the fact of the matter is, maybe they're both parasitic. Maybe applications are parasitic to their.
Okay, so you're the guy in Times Square holding up the sign saying like the world is ending, like a little bit. You're like,
what does that
everything
mean?
Well, you're saying all value is trending to zero. Like you're like all execution value is trending to zero, all application value is trending to zero, and that might, I'm not saying that's.
I look at this like in an extremely. I'll say one last thing. This is like an extremely reductive way to look at this. Okay, but like I try to zoom out and I look at like, okay, what does it really truly cost to update a shared database? Like, what is the marginal cost for a group of people to come to consensus, i.e., message each other through a gossip protocol and update a shared database? And my perspective is that in the long run, there's not a ton of computation being done with ASICs. There's not a ton of energy being used. It's not that costly to agree on the ordering of some transactions. And so it's not
not the cost.
What do you think the cost is?
The cost is not the cost of the validators. No. The cost is not the cost of the validators. It's the opportunity cost of whoever else wants that spot on the blockchain.
That
doesn't matter with a single sequencer, right?
This is why I'm trying to push this debate in one tiny direction, which I think is like more what your original tweets were about, which is each new incremental L1 or L2, right? They fragment demand somehow. They sort of like move liquidity somehow. And there is it does feel like there is some carrying capacity. So one thing you could debate is you can keep adding more supply, right? Like, hey, there's always demand for L1s. There's always Koreans in Upbit who are willing to buy it. Or is there some like finite carrying capacity? Like there's sort of like just some limit at which after that you've basically added so much supply that it's like impossible for demand to keep up. Now, I think, you can argue that there are markets where that is true, right? Like GPUs, right? Like clearly there's just like no way to meet the supply is never going to catch up. But here we have this opposite problem where the increase in L1s has actually made block space so undifferentiated that people just don't see the reason to induce demand from that. So I want to hear your arguments for why what the value of the incremental L1 is or L2. And like, in my mind, there's some notion in which each incremental thing increases supply, but it also causes some amount of demand destruction or demand fragmentation. And, what does that mean for when you're like the 100th L1?
So again, I think this is a bad mental model of what people are doing when they're trying to build new L1s. So if you look, for example, at our funds, we've been investing in crypto since 2018 at Dragonfly. And in every subsequent vintage, we've invested in fewer and fewer L1s. Now, in every vintage, people obsess over the L1s because they're the most controversial. And why are they the most controversial? In large part because they're playing the biggest game. The most valuable things in crypto are blockchains, period. They're more valuable than fucking Coinbase and all the other stuff in this space. And anytime that you're going after the king, people are going to get really upset and it's going to cause a lot of controversy. In the same way that, somebody trying to build a new social network is in some ways like the most controversial thing, the thing they're going to get you the most laughed at, get people the most angry, get them the most worked up, because it's seemingly so absurd to try to go after that prize this many years into the game. And yet you see things like Blue Sky, you see things like TikTok that actually can emerge. It's very rare. Once you see that consolidation and once you see that, okay, the pantheon is kind of set, we know who the players are of Facebook and Instagram and blah, blah, blah. People just naturally become very cynical that, hey, anything can change now. It's done. And it's just what you see in the history of technology is that it's certainly true that there's lock-in, there's network effects, there's moats that make it very difficult for new players to compete, which is why it makes sense as an investor that you would be investing in fewer and fewer of these people. In the same way, VCs are investing in fewer and fewer social media companies. They do still sometimes invest into them. There are people who invested into ByteDance. There are people who invested into Blue Sky and whatever, all these new platforms. But when you see every subsequent vintage, there's fewer of them because people realize that it's harder to overcome those moats. Now, fundamentally, when it comes to social media, what you're betting on is something very different, right? What you're betting on is a new modality of interaction that just fundamentally supplants what was before it. And in crypto, what you're betting on is something quite different because this infrastructure, what's increasingly obvious to me, and it seems to be kind of not obvious to a lot of people, and I'm not sure why, is the idea that blockchains themselves are not done. Like we're only, Solana was just created 5 years ago. Ethereum was created 10 years ago. There's no technology that basically we built it and then 5 years later we're like, oh, we're done. Who would ever want more than this? Who would ever want more RAM than 16 gigabytes? Who would ever want more than an H100?
I think let's just take like the sort of cynical non-crypto investor take of this would be like, well, all of these other movements you're talking about, whether it's social networks or AI, had much faster growth from launch to network effect than any of these cryptos.
No. What depends on where you call the starting line, right? AI has been around. How many AI winters have we already been through to get to where we are today? If you draw the line here's after ChatGPT, then okay, then you're kind of saying here's how far crypto's come after DeFi summer.
I'm just saying like there is a sense in which when people look at the private investment value versus the public investment value, that trade-off kind of usually reflects some duration mismatch, right? Where like the liquid investors are unwilling to hold that duration. The private investors are willing to hold that duration. And there's some like convergence between them. And my point is just more that the valuations that are being implied sort of imply much faster, the liquid valuations imply a much faster growth rate than what you see if you compare it to tech.
Than what you see where?
Outside of crypto. Right. Like
I mean, again, I would dispute that this is true. I mean, look how much AI companies are being valued at with basically nothing.
With
just
real
like a team.
Yeah, but they have customers.
Real revenue. What are you talking about? Look at all these companies that raise like $1 billion with just like a team and not even a description of what they're building.
The SSI ones are kind of weird, but I mean more like an Anthropic.
I think let me ask a question to Haseeb here. You guys invested in Monad, right? You responded to me. You responded to the tweet that you did, like you mentioned that you did Monad, and I mean, I would just a side note, like to me, this is a little bit of an example of, you invested in a valuation that Paradigm and Keone and the market makers are probably going to give you a good return. Okay, just like so that was to some extent my point when I said
to be
that
clear, at the time that we invested, we did not know that it was going to be a good return. Obviously, it's clear now.
I'm not disputing that. You guys take risk. Okay, like this is not my point. But let me ask you something. You invested in Monad. What is the we were just talking about valuations, right? Like Tarun's talking about, like these valuations are like very, very high and, very little to show for it. Whereas some AI companies have revenue, some agreed are just college kids who put AI at the end of their...
There's like 2 AI companies that have revenue.
Okay, agreed. Okay. But you invested in Monad. Like, what is the value of the Mon token to you? Like, now I'm just like basically turning the question back around. Like, what do you think, what justifies 3 billion or what justifies 100 billion in the future? Is it money? Is it the REV that it generates? Like, is it? I mean, I'm genuinely curious. It's the REV it generates.
It's the REV. It's that if Monad becomes the next Solana, here's how valuable it can be, right?
Okay, so this is where
it's very much based on comparables, right? Now, look, if you fundamentally reject the comp, then go short the fuck out of Solana and like ride off in the sunset, and you're going to make an enormous amount of money. Not enormous. You'll 2x your money. in the case where Solana genuinely converges onto the utility value.
Talk about conviction right there.
Well, I mean, if you short it with leverage if you want to.
I think it's funny. You're like you're gonna make infinite to 2x very quickly.
Well, I mean that's how shorting works. I mean, unfortunately, that's just
I know. But it's funny you corrected yourself so fast.
Right. But I mean, it's arbitrarily scalable, right? Like there's an infinite amount of demand if you wanted to short your entire portfolio of this, you can. So I think so the point is like, look, I take the market comp at its face value. Market's gotten decimated. There's very little risk appetite, and yet people still think Solana's worth, whatever it is, 80 billion or whatever it's valued at today. I think this is more or less correct. I don't think I have any edge over this market in figuring out what is the terminal value of Solana. And I think markets are giving credit for the fact that REV will probably never go away. Tarun, obviously, you're a big proponent of the idea that MEV is an intrinsic part of how blockchains and blockchain validation works. Yeah. It'll never completely get erased. And I think that's how the market is thinking about it. That's how I'm thinking about it.
Yeah. So this is probably where
fundamentally. Go ahead.
Okay, so I mean, I think we're finally converging on it. And I know I've been a little bit like, all over the place, but I think this is where we're finally converging on like something we fundamentally disagree about. I don't believe that REV in the long run is a source of earnings. And my rationale for this is I step outside of the crypto space for a second. I think, okay, what is the demand to use a shared database where large financial actors, real institutions can be reorged and sandwiched? And I just do not believe that this is a massive unlock for finance. Like, again, zooming out, I do not believe that there is massive demand for the world's financial system to exist atop a shared distributed system where there's permissionless ability to reorg, sandwich, front run, back run transactions. I do not believe that.
So let's say there's no reorgs. Okay, there's some kind of reorg resistant consensus algorithm. And let's say sandwiching, there's like, okay, everyone's using flashbots or whatever something. Do you think, okay, we remove those two? Front running will always exist because that's just people competing
and
for
that exists everywhere.
An opportunity.
Wait,
yeah,
just let me ask you something. Like, why do you think sandwiching is like definitively going away? Like, I feel like there's always the ability
you just have
to
private mempools. You can just have private mempools, right? Private mempools make sandwiching go away. That's just
yes, but they also make the price more inefficient. So there is a trade-off. They're not free.
Yeah, fine.
It's not free.
Yeah, fine. But let's say, okay, sandwiching goes away. There's a law that's whatever. Who fucking cares?
Yeah, regulation is what does away with sandwiching.
No. It can be purely private actors deciding to use private mempools.
Okay,
right.
All right.
So if everyone uses private mempools and it's just a business arrangement, normal validators will sandwich you all day long. But there's one validator out there who's like, you know what? I promise that if you send flow to me, I will never sandwich you. Therefore, send me all your flow. And that validator gets more and more demand, and then boom, what do you know? Now we have an equilibrium where no one's getting sandwiched, and all the sandwichers are not getting flow, right? You can imagine this world pretty readily. Let's say we're there. We're in a world where there's no more sandwiching, there's private mempools. In that world, there's still front running, there's still back running, but there's not sandwiching and there's not reorgs. Do you think that is still a world that is totally implausible that financial actors could adopt this technology?
I think it will greatly reduce the number of use cases for a blockchain. My mental model is absurd.
That will greatly reduce.
Yeah,
if you remove sandwiching.
No. I'm saying that I think that even front running and back running will even the ability to permissionlessly validate a blockchain. Anybody can join. I don't think this is how equities and commodities trade in the future. I think it looks like single sequenced L1s. I mean, this is like generally outside of, the few general purpose blockchains, this is generally the direction that people are going.
In case you want to remember, the CME is a central sequenced L1.
Yeah, exactly. So I mean, this seems to be the direction that people are going. And I do believe that like what crypto looks like in the long run.
I love that Gwart is a base. He's a base bull. He's a base bull.
No, it very much. Right. But here's the thing. It very much depends on the nature of the assets being traded. And again, why would you subject yourself? Why is Tesla going to subject themselves to some, arbitrarily?
Okay, well, so we don't need to establish that it's a primary market for Tesla. I mean, I don't think that's required for the blockchain story to make sense. Like these things will probably still trade on CME, they'll still trade on NYSE and NASDAQ and whatever. But like, okay, what do you think explains the rise of stablecoins? We've gone in the last year with interest rates being at 5% from 130 billion to like 240 billion of stablecoins.
Yeah, I think stablecoins,
despite the fact that crypto trading has been sideways.
Right. I mean, stablecoins are a great use case, but you guys just invested in an L1 that's like purpose built for stablecoins. Is that correct?
Yeah, correct.
Okay, a tremendous amount of stablecoin for first of all, payments are zeros. Okay, I'm sorry. Like, there's other ways to make money as a result of facilitating payments, but I don't believe that like payments are going to be some massive revenue generation for blockchains. Like, I don't believe that, because I think the alternative is using USDC on base, which is
hey. I have a petition that Gwart has to rename himself DCF God, because he's all about the cash flow valuation.
Hold on. Look at how much revenue Tron is making this year. Where do you think that revenue is coming from? It's all coming from payments.
I think that's going to be disintermediated. Like I think that's going away. A lot of how we understand crypto is in inefficient markets. I mean, AMMs were wildly inefficient for 5 years, right? Like we progress.
I think one thing, though, that seems to be different is like you care about this like end state equilibrium and you're valuing things right now at the end state. Whereas like Haseeb seems to be like, well, it might take so long to get there that there's value to extract in the middle.
That's
right?
fine.
Which is true, right?
I mean,
that's an investment.
I wrote a blog post in, 2019, 2020, talking about how AMMs are not long for this world and that, everything was going to move to RFQ. And I was 6 years too early for any of that to happen. It's still the case that AMMs are dominant. Even today in 2025, AMMs are still dominant.
I mean, look, Pump.Fund wouldn't exist without it, right?
Absolutely. And so, like the one thing that you learn as an investor is that being too early is just being wrong. That's just it. So saying that, like, well, everything's going to trend to zero and fees are going to go down and blah blah blah, and like the margins are going to get compressed. If you're 15 years too early, then you're wrong. You're just wrong, right? Like that's not how an asset is going to be valued. Is based on what it's going to be worth in 20 years, right?
Yeah, but if we agree on it,
discounted cash flows. That's why they're called discounted.
If we agree, then like we're sort of converging on, okay, well then like a lot of these assets probably are only have a shelf life of 5 years. If we do agree that like the long run is...
I don't agree. I have a lot of uncertainty about it. I think it's like really hard to project what happens in 10 to 15 years. I agree with you that that's possible. That's definitely a possible rollout of how all this stuff plays out. It's also possible that these things just manage to capture a lot of value. And I think increasingly that's my mental model, is that this stuff is less like commodities and more like real estate, right? You could say like, look, what is the marginal value of land? Well, go to Montana and go find a random plot of land. It's cheap as hell, right? But you say, okay, what is the value of a plot of land in Manhattan? The answer is it only gets more and more valuable every passing year. So if your mental model is that, well, block space and like, a bunch of servers coming to consensus, that's so cheap. The cost of this will go to zero. I think that's just probably not the right way to think about what is the actual opportunity cost of the block space. And if you control that, which is, it's basically more like being a landlord. If you are the landlord of this very, very valuable real estate that becomes more and more valuable over time, yeah, you can get really fucking rich just being a landlord.
But this is why I kept bringing up this point of like incremental new blockchains relative to demand. That's the part that doesn't make sense.
You can start a new city in California. All these VCs that are starting a city outside of
the network state type of stuff.
Yeah, network state type of stuff, right? You say, well, we're going to start infinitely many new cities, so New York City value of real estate should collapse to zero. It's like, well, no, that's absolutely not how it works. Like what you see is actually the value of real estate in these mega cities is only becoming more valuable.
I agree, but I think block space is a little bit weirder, right? Where like, yes, for like the top mega cities, like the Bitcoin block space, that is your New York analogy. But the like 15th biggest city in the US, like who the fuck wants to own real estate there? It's so volatile.
I mean,
it gets completely
city in the US, like
probably
Austin
some shithole like Denver.
Nashville.
Yeah, it's probably some shithole like Denver.
Real estate in these places is going up. It's going up everywhere.
Actually, not really. Not right now. You're wrong.
Okay, not right now. Obviously, right now things are very bad. But over time, if you smooth out these charts, these things are getting better. I do have to run, so maybe we'll have to do a part 2 on this. But we still didn't really get a chance to talk about
we got to do part 2 now. Yeah, we got to do part 2.
Yeah.
So we didn't talk all about VC. We just talked about chains.
I do think it's funny. We started as like trying to do a debate, but then this turned into like brawl, which I like. I think the brawl aspect is kind of funnier.
I think we went back to first principles. Like genuinely, I think that we went back to like a lot of what I think this space has agreed upon for reasons that I may disagree with fundamentally. Like there's a lot of things that I think crypto has decided is a first principle off of which it works. And I kind of come back and I say, hang on now, like I'm not sure I agree with that first premise. So it's good to talk about that maybe.